Hello and welcome to Camel Finance. I'm your boy Camel, and there are a lot of concerns at the moment that the property market is about to crash. So I thought I would dive into this. The UK prices have risen by 1.1% in April for houses, which brings the average price to a new high of £286,079. Over the pond, our American brothers and sisters, in 2020, the average house price was 391,900 US, and today we are at $453,700 US, which is a new all-time high. You can see here. So you may have seen that the interest rates have been hiked by both the Bank of England and the Federal Reserve in America. I've got here a worked example for how this translates to the average person like you and I. A rise of 1% on a 25-year mortgage at a standard variable rate of 4.24% means you're paying an extra £756 a year, which is £63 per month. And you might be thinking, well, that doesn't sound too bad, although obviously no one wants to pay extra money, especially in today's environment. But hold my beer, let me show you how this gets pretty ugly pretty fast. If the interest rate went to 1.75%, so up another 0.75%, and this is passed on, it would mean an additional £3,108 a year, which is £259 a month. So you can see how things start to get really bad really fast. And of course, if you're renting, then this is likely going to be passed on to you as well. So whether you are a variable rate mortgage owner or a renter, this is something that is going to start to squeeze everyone. It's only really those that have fixed rate mortgages that are immune to this, and they're only immune to this for as long as you have fixed your rate for, of course, and then you're going to have to remortgage and pay these higher rates. As energy bills and inflation squeeze living standards, and as real wages decline, people are becoming more fearful of risk, which means we can likely expect a further dent in house prices, right? A look at the news will just tell you that there's an awful lot of fear out there, and of course they really get off on this stuff. They love to scare people, and they love to post fear and draw fear. And they do this because, honestly, that gets them the most views. So you can see these headlines: threats growing for UK housing market slowdown, people are ringing the alarm. This all sounds very nasty. And in the UK and the US, the housing market risk is growing. We've got interest rate rises by the Bank of England and the Fed. There's a threat of recession, high inflation, and all of this puts a squeeze on household finances. Real world wages are declining. The Bank of England just hiked from 0.75 to 1%. The Fed just hiked by 0.5% to its new target range of 0.75 to 1%. And more rate hikes are expected until something breaks or until inflation is tamed. So we can all expect higher bills, higher mortgage payments, higher rent, higher credit card payments. It's only really fixed rate loans that are unaffected, and as I said before, these are only unaffected until you have to go and rejig them at the end of your 2 or 3 or 4 year fixed term. So all of this dampens buyer demand. We've got these experts from these places saying the house price growth will slow sharply later this year, and more experts from more places saying that the Bank of England decision and possible future increases would ensure a steady and sustained upward trajectory for mortgage rates. So what does that mean going forward? Well, before we go forward, let's take a look back in history. In 1994, the Fed rates were 3%, with the mortgage rates around 7%. And the Fed increased the rates to 5.5%, and this put the mortgage rate at around 9%. But as a result of this, the property sales went down by 20%. Today, the Fed rates are near zero, coming towards 1%, with mortgage rates around 3%. So the Fed says it's aiming for 3%, which means the mortgage rates could be around 5% by the end of the year, which is seemingly not as bad, but sales are expected to drop around 25%, and here is the article that shows this: housing boom loses steam. Home sales may drop by 25% by the end of summer, says analyst. Again, sounds kind of scary. What does this translate to in real numbers? That would bring the annual pace from 6.02 million homes to 4.5 million, so it's quite a significant drop. You might remember at the start of the year we had an inverted yield curve, which is usually a very reliable leading indicator of a recession. And so again, all in the news, there's all this fear, and everyone's quite worried that we're going to enter a recession imminently. However, as I've covered on this channel before, The yield curve is a good leading indicator. It's usually fairly reliable. However, it does lag by 12 to 18 months. So since it only inverted at the start of this year, it's not really reasonable to expect a recession to hit anytime soon. Everyone is worried that the rates are being hiked and that's going to cause a recession, and it may well do. But I think it's a little bit premature to start worrying that we're going to see a giant recession just because the 10-2 yield on the treasuries has inverted at the start of this year. It'd be much more reasonable to expect the recession not to occur until at least the back end of this year, and likely into next year would be more realistic. So we've got multiple forces at play here. On the one hand, the rate hikes and the cost of living increase makes it much harder to buy homes. If you're not already on the ladder, then house prices just going up because of inflation, cost of living squeezes, and then the additional interest rate making the monthly payments higher. All of this stuff makes it harder to buy homes for first-time buyers. On the other hand, houses historically hold value very well during periods of high inflation. And that's why we haven't really seen the house prices dip yet. They are just potentially starting to, but if you zoom out and look at a chart over the longer term, and anyone that's owned a house will know this as well, it just goes up every single year. And another point to make here is the banks are buying and holding property, and they have been all the way through this C19 era. I've shown this before, but I'll just show it again because it's here. Banks, pension funds, and asset managers are buying thousands of new build starter homes, and they're doing this, because of this. They're doing this because historically, houses hold very well during high periods of inflation. They retain their value. You can store value in a property, especially with a time horizon of over 4 or 5 years. If you look out 4 or 5 years into the future, then you can be near certain as you could be with a store of value, that house prices aren't going to have been on a huge decline over multiple years. So with everything said, let's finally answer this question. Are we going to see a property crash this year? Well, if we get a C19 type plunge, this is an enormous crash in every single asset, then yeah, short term you're going to see house prices decrease because everything is going to decrease. In times of crises, all assets trend to 1 for correlation. So house prices would be likely to suffer short term if we get an enormous C19 style crash. But at least for the remainder of this year, it seems more likely that the housing market's going to hold up okay. And as I said, this is because we've had a yield curve inversion, which tells us that we should be open to a big recession. But it's not until 2023 that we might have to be more open to this actual property crash, because as the yield curve inversion tells us, this is a leading indicator of approximately 12 to 18 months. So we should be able to get at least through the majority of this year without a big recession, and likely into next year as well. Next year we would have to be much more open to a property crash that comes off the back of a big recession. And lastly, remember that while property prices crash sometimes, inflation is going to remain persistent. The Fed will eventually either have to break something and pivot on its interest rate hikes, or it will claim that it's tamed inflation by saying, look, we got inflation under control by raising interest rates, and now they can start to pivot to easy money again. All paths eventually lead to the Fed pivoting. And when the Fed does pivot, because it has no choice but to eventually pivot, and of course the Fed and the central banks, they want high inflation so that they can justify their transition to CBDCs. So ultimately all paths lead to the Fed having to pivot, to the central banks having to pivot and go back to easy money. And of course when they do, all asset prices, stocks, gold, Bitcoin and property, are going to explode. So for the remainder of this year, I think it's reasonable to expect that not a great deal is going to happen to the property market. Of course, that's on the basis that we do not get a C19 type of crash. If we do, then everything is going to plunge together. And I think that we should be much more open to a recession next year. And during this recession, it would be reasonable to see property cool off. But until then, I don't think there's any requirement to panic. I don't think there's ever a requirement to panic, to be honest. If you found value here today, I'd appreciate if you subscribe to the channel, drop a like on the video, share it around, and until next time, take care.